We like to buy a combination of property that is fully dilapidated. We're going to go in, take it down to the walls or the studs, rebuild, hand that over. Or it's a value add, where you're gonna, go in and do, 25,000 or, $50,000 worth of work or something like that, and put it on the market or lease it out, that kind of thing. So I think having options is very important.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. Today's guest is Peter Neal, who is a co-founder of GSP REI. His company focuses on acquiring distressed and value-add properties, redevelop them for resale and rental. They also purchase land for new construction, and their same exit strategy, either rent or sell for profit. Peter plays an active role in overseeing all aspects of the business, including acquisition, construction, asset management. But his main focus is investor relationship and raising capital for company's fund. So Peter, welcome to Decoding Cashflow. It's a pleasure having you on the show.
Ted, it's a pleasure to be here. I happy to be talking to you today.
All right. So Peter, before we dive deep into your niche, what you have been doing, if you can give our listeners a little bit background about yourself, what have you been doing before you got into real estate? How did you get into real estate, and what's your main focus as of now?
Sure. So I'm from the Philadelphia area, so we're not too far from each other. And growing up, my dad was a property manager, facilities manager for CBRE mostly. Worked at a couple different shops. So that was probably my first introduction to the real estate business. And honestly, I thought, man, I don't know if I want to do what he does. It was, like especially now, there's a lot of the hurricanes and storms and things like that. We're not facing it, in Pennsylvania, but anytime there was, bad weather, snow was a big thing growing up. Every winter we'd get a lot of snow, so I'd hear him up, in the room across from me, on the phone, 2 o'clock in the morning, stuff like that. And, and he moved up over the years, but it was still, it was just part of the job, and he loved it. He retired during COVID, but he tells me every day he still wishes he was doing it. But for me, as a young guy, I just thought, man, I don't know if I want to do that. So I went to Temple University. I majored in media studies and entrepreneurship. And I thought I was going to work in television or radio. And, I liked that, side of the business. So after school, I ended up taking a job for a real estate investment company in marketing and sales. And it was more of a distressed mortgage investment company than it was necessarily a real estate investment company. But obviously, mortgages are backed by real estate. So I learned an awful lot. It was a small firm at the time, and it was kind of the right-hand man to the president and CEO. And he didn't just manage that company. He had a lot going on in the background as well with his portfolio. And, his background was very heavy on the raising capital and in that side of the business. So he taught me an awful lot. I saw real estate from a totally different perspective, through investing and maybe working with property managers and maybe not so much being one. Even though today we're vertically integrated and we do all the property and construction management, I think there's a time and a place for that in your business. But yeah, that was kind of my my introduction to seeing things differently and seeing things from the investment perspective. And that was 10 years ago in November. And I never look back. This is something where I think when you're introduced to this world, it's something you shouldn't take for granted. There's a lot of blessings that can come from it, and amazing people and opportunities for wealth creation that lead to a lot of other things beyond just wealth. So I never never look back. It's something I don't take for granted. I was fortunate enough to have the opportunity 5 years ago to co-found GSP REI. And today our main focus has been for the last few years, workforce and affordable housing. We very much look at real estate from a supply and demand perspective. So we look at the markets we're in, Philadelphia, in Baltimore, some parts of South Jersey, and we see a massive undersupply of workforce and affordable housing, and just unbelievable demand, historic demand, and it's continuing that way. It's not like it's going backwards or something like that. There's nothing happening on a state, local, or federal level that's really creating more affordable housing. And most initiatives tend to be more on the commercial side of the business, so it goes towards larger hedge funds and firms like that, and it's the development of multifamily apartment buildings through Section 8 and market low income housing and things like that. And there's a massive need and a want for single family options in that workforce and affordable housing space. So that's what we focus on. My partner Ron has been in the construction business, real estate investing business now for over 20 years. So some of the guys on our crew have been with him for over 15 years at this point. So he was somebody that I really wanted to partner with because he had that background in construction, and we could probably speak more towards my philosophy, and some of the questions you have coming up about, how to be successful in this business, and how to kind of find your strengths, focus on your strengths, and then find other people that can help you, that have different strengths, and you can leverage those and create some amazing partnerships.
Yeah. And as you mentioned, you're mainly focused on, the affordable housing side of it, right? Single family
Sure.
affordable housing, I would say. So how did, like, before you jumped into this segment, as you mentioned, you were mainly focused on distressed mortgage.
Yeah.
How did that experience help you connect the
Sure.
dots between what you're doing right now?
Yeah, well, the distressed mortgages, a lot of them were backed by what I would call, workforce and affordable housing,
Okay.
single family homes in, low to moderate income, middle income areas. Though when you're dealing with, depending on how you buy them, typically they're in large tapes, and you get what you get. So there were certainly really nice homes, that were owned by doctors and attorneys and, professionals, $1 million plus type homes as well. But a lot of it was more on the workforce and affordable housing side. And then, like I was saying, that the CEO that I worked with at that time, he had his own single family and small multifamily portfolio, kind of similar to what our portfolio looks like today. So he was my introduction to that space even 10 years ago. And he's really the one that taught me how to analyze, how to find deals, how to analyze deals, how to underwrite them, how to manage them, how to work with contractors, all that kind of stuff. So he
Yeah.
really laid that foundation. And at the time I had no idea, that's what I was going to be doing, and but a lot of times I go back in my mind and think over those days, and kind of those certain learning lessons and things like that had come up. And it's amazing, how much crossover there is. And we have a distressed mortgage side of our business. My partner Wade runs that. We have a private equity partner that funds the entire portion of that business. So right now we don't raise capital from accredited investors to operate that strategy. But I
Mm.
think we've been talking about it a lot. It's an amazing strategy. It's different. It's similar, but it's different. We're buying in the note position. And typically we do a lot of HECM loans, so the reverse mortgages. So the property's
Yeah.
typically vacant, and then we're exiting through the property a lot. Most times we're not, about, I would think 90% of the time we're actually physically touching the property, adding value to it in some way, shape, or form. But that is
Mm.
much more diverse and geographically, so we have
Yeah.
properties in 40 different states, and we'll work with contractors. Whereas with what we do on the rental side, it's kind of, for right now, it's been where we can go, and where we can be boots on the ground, and where we have our crews and our relationships partnerships and things like that, so that we're doing everything in-house, because I think that is such an important part of this business, doing it this way with workforce and affordable housing. To be able to control the construction, the timelines, the budget, all that kind of stuff really helps with, getting amazing margins and making deals work, to some extent. Not that they wouldn't work, if we were outsourcing everything, but the margins certainly wouldn't be as good.
Okay. And as I mentioned, right, for the affordable housing, you mainly deal with like in Pennsylvania, Baltimore, Southern Jersey,
Yeah.
those areas. But what are your main criterias for acquisition? What are the things that you look into,
Yeah.
price point wise, value add wise, before you acquire that property?
That's a great question. So, you don't want to buy in war zones. I mean, just because you're investing in workforce and affordable housing, that doesn't mean, the bottom of the barrel, the war zones, places that you don't feel comfortable driving through or something like that. We want to invest in areas where we're seeing a very robust market from a resale perspective, that there's regular homeowners buying in the areas where that we're buying in. A lot of times you'll see in the war zones, it's only investors.
Yeah.
It's buying and selling is all being traded through investors on both sides of the deal. Whereas in the markets that we're playing in, the area, the kind of pockets that we've identified in those markets that we like, we're seeing a very robust market for regular homeowners buying properties. But we're not, but to your point of what kind of product are we buying? We're buying fully distressed, dilapidated homes, stuff that's typically under $50,000 at acquisition cost. So there's a heavy amount of construction needed. Your
Mhm.
average homeowner, 9 out of 10, 9.5 out of 10 is not going to be buying property like that. So we're not competing with, regular homeowners when we go to buy a property. We're not even, a lot of times, not even competing with other investors, because a lot of investors, it boggles my mind. I know why they do it, because they don't want to do so much of the construction and dealing with contractors and things like that. They tend to go more towards the value add. Like, I get
Mhm.
calls every week from wholesalers, and they'll be like, "Well, I don't know if you're going to want this property. It's really run down. It's fully dilapidated. I mean, and it's like, that's what we want. We want to just build within the four walls. So take a property down to the studs, or even the brick, and then just rebuild. At that point, we're handing over almost new construction to the tenant. So we're maximizing value, and then it's a lot less work for us from a management perspective. When you go in, and it's not, we do value adds as well. We don't shy away from a value add. A lot of times those properties they have a tenant in place, undervalued lease. We have an option at that point when the lease runs out. If we want to terminate lease, go in, add value, and lease it at market rent, or lease it through a Section 8 program.
Mhm.
But I think it's important to have options. That's one of the things I really like about single family and what we do. We're investing in product where we have a lot of different options. So we can hold the property as a rental. There's a ton of demand for that in the areas that we're in, or we can resell it, and there's demand for that as well. I mean, and then
Yeah.
same thing with what we buy. We like to buy a combination of property that is fully dilapidated. We're going to go in, take it down to the walls or the studs, rebuild, hand that over, or it's a value add, where you're gonna, go in and do, 25,000 or $50,000 worth of work or something like that, and put it on the market, or lease it out, that kind of thing. So I think having options is very important. I would say kind of one of our kind of secret sauce things that I would share is we tend to invest a lot around hospitals. And I wish I
Yeah.
was smart enough to say we did that purposefully, but it just kind of happened that way.
Yeah.
Over the years, as we've analyzed our portfolio and come out with new offerings and things like that, and really taken a deep dive into what was working and what we liked and all that kind of stuff, it's just so many of our properties, especially the ones we really like, are tend to be in a very close radius to hospitals.
Mhm.
And I think a lot of the reason for that is those areas, those pockets tend to have hospitals do a lot of what they call community investment. So they'll own property, they'll own land, they'll invest in the community in other ways that, they don't want to be in war zones either. They want to
Yeah.
see the area that they're in heading in the right direction. So that's one of those things where, we that's something we take into consideration. And then we look at crime maps, we look at schools and things like that, to just see that the area is trending in the right direction. And that goes back to just having a robust economy, and people, regular homeowners buying in those areas as well. I think that's important.
Okay. And how do you get the leads? Like, do you go to the regular MLS, or do you connect with the wholesalers, direct marketing? What's
Yeah, yeah,
yeah,
all the above, so we don't
okay.
shy away from any one channel. In Baltimore, there's a very robust auction. There's auction sites in Baltimore. A lot of product goes on, so we tend to buy a
Mhm.
lot on the auction sites. We have really good relationships with one that's been around for a very, very long time. Whereas, like in Philadelphia, I don't think we've ever bought anything on an auction, on an online auction. So that is kind of unique to that market, and other markets might be like that as well. So it's depending
Mhm.
on where you're at, it might be something you want to look into. But in Baltimore, they have a very active online auction scene.
Is it
Um,
like a foreclosure auction, like a sheriff
no,
sale?
no, no. It's
Okay.
the one that we like to buy from is called Ashland Auctions,
Okay.
and it's I think maybe sometimes they get foreclosure and stuff like
Mhm.
that, but it's no, it's just a regular auction, and anybody can put their product up there and pay what their fees or whatever, and we just see a lot of product, and we work with wholesalers, but it's kind of funny. A lot of times, product will end up on Ashland, or we'll see it before somebody even brings us to it through a wholesaler or something like that, but we certainly work with wholesalers. We work with realtors. Anybody that has deals that fit our buy box, we're happy to work with them. And we do some direct to seller marketing as well. Because in Baltimore and Philadelphia, probably in any urban metropolitan area, there's going to be pockets that you want to be in and pockets that you don't want to be in, and it could be it could be block to block. You know what I mean? You really have to know where you're investing in.
Yeah.
So if there's areas that we have identified that we really like, then we're going to go after those areas, and we'll make phone calls and direct to seller type stuff, direct to owner. So we don't shy away from that either. So any kind of tool that we have, we'll use it. But a lot of times we go to the auctions, and we work with some wholesalers and agents that have a lot of relationships and bring us a good amount of deals. And one thing we really like about Baltimore, especially, and why a lot of our focus has been there, is there's over 13,000 vacant homes in the city.
Yeah.
So, for what we do, our strategy and our model is very repeatable. It's very scalable, very repeatable, and there's a lot of the city, the mayor, the even the governor of Maryland. They want to see those homes being redeveloped, and so there's not that they've eliminated all the red tape, but they're certainly pro development to some extent, and they're motivated to see these homes redeveloped.
And yeah, I have a little bit idea about the Baltimore market, but maybe you buy over there. So uh, what are the pockets, like, Northeast, Southern? What are the pockets in Baltimore where you think that's a good area and you'd like to invest?
Yeah, it's all over the city. There's pockets, and I
Okay.
mean, like if you look at, and I think if people go on our website, one of our recent presentations, we have a screenshot of our portfolio. Now it's zoomed out. I mean, so I'd say reach out to me. I can give you a closer view of it, and you'll see the Baltimore market, and we have pockets all over the city. So we don't shy away from like a West Baltimore or something like that. I would say like where Bon Secours is, that's a hospital. John Hopkins obviously is a very popular place where people want to invest. But there's little pockets, and they all have their names and things like that that we've identified that we like. And I think it's if you're investing in areas like that, and even suburban areas and all, I think it's very important that you have those areas that you want to invest in, especially from a single family standpoint, because having scale in a certain area, and that's in a lot of ways we've put the blinders on in the markets we're in and in these pockets, because having that scale is going to allow for better in-house hires. I mean, people that you can make good. Right now we have a great team around us, but as we can continue to grow, continue to make those hires and things like that, I think it's very important to have your kind of pockets identified and work those areas to scale up in that sense.
And when you select a property, right? When you try to buy, how do you evaluate the property based on, you want to buy it below like 20% or 25% ERV after you
Mhm.
have fixed everything? What's your criteria on
Yeah, yeah.
financial?
So our buy boxes is we want to be all into a property for about $130,000, give or take.
Okay.
And that could be a property that we buy for 30 and put 100 into. Could be a property that we buy for 100 and put 30 into. Either way, we like to be in that, roughly
Okay.
all into 130 or less. We'll go a little bit more if the ARV supports it. But we
Mhm.
like to stay in that arena because it creates more diversification. Like if we
Right.
did more in Philadelphia or the suburbs of Philadelphia, we would be upward closer to, 250 or 300, or
Mhm.
suburbs of Philadelphia might be 4 or 500. So it's just you could buy one property instead of buying, two, three, or four or something like that. So and then we want to see an ARV really at least 185, on the low end 185.
Okay.
Ideally closer to 200, which is typically what we're seeing right now. Sometimes over that. And so we're creating 30 to 40% equity in every deal, and we're putting 70% loan to value, long term, 30-year fixed, 30-year AM debt in place, typically through portfolio loans. Once the property's leased, right now rents are about 1,700 is where everything's going out at. I would say our average is probably closer to 1650 because you have some older leases, but new rents are about 1,700. And we'll put a portfolio loan on and just rinse and repeat. But yeah, we want to see at least 30 to 40% equity creation, whether it's a full gut renovation or it's more of a value add. And we want to see about three on the low end of about $300 of net cash flow per door. And the higher we can make it, the better.
Right. Right. Sounds good, man. So, especially like when you say portfolio refinancing, so you keep the property, you put it on the rent, and once you have like five or six, how many properties do you put in the portfolio
Yeah,
before you
so it'll
refinance?
it'll vary depending on the product on the debt piece.
Uh-huh.
I think it's right now it's been about like 2.5 million in value. I
Okay.
mean, so you have, usually we'll do somewhere between 10 to 20 properties or so. But usually for a
Mm.
portfolio refi, they're going to have some, minimum value that you need to hit.
Okay.
So once we hit that, we'll work towards a portfolio refi. If we're staying within our buy box, we're pulling almost all of our capital, sometimes all of our capital, if not, leaving very little money in a deal, and then just rinse and repeat.
Okay. All right. So as you know, like everyone has their own different strategies or
Sure.
ways to invest. You are more focused on single family affordable housing. Some of the people they will say, okay, multifamily might be better because due
Yeah.
to the scaling, uh,
Yeah.
they can scale faster on multifamily. They can have less overhead in multifamily properties and so on, right? How do you compare these single family affordable housing compared to multifamily? What do you think are the pros and cons according to you?
Yeah, that's a great question, and depending on what type of investor you are, I think one could certainly be better or worse for you. And I mean, I think the advantages in multifamily, having the economy of scale on day one, you can't beat that. And I mean that there's something to be said for that. If depending on the size of the property, being able to bring in-house or bring in, third party management, on day one, with a firm that has good resources and good track record, all that kind of stuff, that really comes in handy for some people. Now for us, like with my partner Ron, who's been in the construction business over 20 years. We had a very, very strong network of guys on our crew, and we can scale up and down depending on what we need. Really strong network of subcontractors. If you're gonna find success in single family, especially in workforce and affordable housing, I think the vertical integration is extremely important because it's going to be
Mhm.
difficult to find contractors, and good people that'll work with you, and you're going to need to find that scale right away.
Yeah.
Those properties are out there, and you can scale up and get it to a point where now, okay, you have 20, 30, 40 doors, 100 doors plus. So now it's like you're practically operating a multifamily property. I mean, you have that economy of scale, but you got to be able to do it, somewhat quickly. So having really good, it's going to depend on what your resources are, what I mean, and what your network is and stuff like that. So I'm not one of those people where, I know some multifamily guys will, take will crap all over, single family or something like that, or think you have to scale up or, something like that.
Yeah.
But you look at what institutions are doing, they're buying a lot of single family. They bought
They
a
are.
lot of single family over the last couple of years. Now, a lot of them have moved more towards the build to rent space because they can deploy a lot more capital at one time. And that's the thing with institutions. They need to write a $50 million check at least. A lot of them need to write a $150 million check at least. For us, we don't need to do that. I mean, so we can go in and we can kind of curate a portfolio and buy it over the course of time and buy it individually where you tend to get a lot better pricing. We don't shy away from portfolios, but a lot of times they're cash flowing. So, and single family portfolios typically do trade off of an income approach as well. It's
Yeah.
a lot of people say like, oh, it's, income approach doesn't affect single family or something. It certainly does. If you're selling it in a
Yeah.
portfolio, you're going
It
to look
does.
at
Yeah.
what it's valuated off of the cash flow. You know what I mean? But you will take a look at what those properties are valuated to. And I think it gives some flexibility because, I just saw somebody say on LinkedIn, that multifamily could be exited easier than single family. I'm just thinking that you could, right now in certain markets, it's like you could
Yeah.
put a single family home up on the market and have it sold by the end of the day.
Yeah.
Whereas multifamily, you're only selling it to other investors, and that kind of reminds me of the distressed mortgage space. It's just like with distressed mortgages, if you're in a predicament and you need to fire sale assets, you're only selling to other investors. They smell blood in the water. They want a deal. With single family, you have that option. If you're buying right, you have that
Yeah.
option where you're selling to regular homeowners. So I think a healthy portfolio, a diversified portfolio, especially for somebody who's not afraid to invest passively and diversify their portfolio that way. I would say I think there's room for both, and a lot of other different asset classes and things like that. But it's single families is a good place to get started because I think it's easy to understand. You look at it one-off property. What did you buy it for? How much capital do you have in the deal? What's your debt look like? If you have debt, you know what I mean? How did you buy it? You know what I mean? That kind of thing. And then what's the rent? Take vacancy, maintenance, capital reserves, take your management fees and stuff like that. And so it's easy for people to digest. But I think that's a big question, Ted. It's I could
Yeah, it's
probably
the same.
we could
There are
talk
pros and cons
about
of
that
everything,
all
right?
day. I mean, but
Yeah. And
I think there's a place for both at the end of the
yeah.
day. And a lot of times I think like if your background's not necessarily in real estate, multifamily could be a place where you could really leverage the expertise of third party management and that kind of thing. Not that you couldn't do that in single family as well, but depending on the areas, it can be harder to find a good management team to work with. So my answer would be I think there's a place for both, and then supply and demand is different too. You know what I mean?
Yeah.
And you got to look at your markets and stuff like that. But one thing that led us into single family was there's just the sheer supply and demand. There very a lot of supply constraints, especially in Baltimore and Philadelphia, in the markets that we're playing in, and just historic high demand. I think the workforce and affordable housing in general isn't as cyclical as other real estate asset classes. But you're seeing it in the multifamily space and market rents because of the massive development boom over the last couple of years in certain markets. Now where
Yeah.
we're located at, you look at the data. Pennsylvania, New Jersey, Maryland, we're still 50% less supply on market than pre-COVID. Whereas if you go down south and maybe certain parts of the Midwest and all, they've gotten a lot of attention from outside investors, out-of-state investors, institutional investors, private equity investors. So they've developed a ton of units. They've brought a lot of supply to the market. So I think that's an important thing too. I get investors wanting to run to those markets where a lot of people move to. But when you look at the data, a lot of them have that kind of hockey stick type appreciation, where it skyrocketed after COVID because so many people moved there. And then it got attention from investors all over the country. They've driven prices up. They've driven rents up dramatically. So I think it's harder to make deals work. We tend to take a little bit more of a contrarian approach. And being in the Mid-Atlantic and operating, in the Philadelphia, living in the Philadelphia area, we're doing the best with what our markets kind of give us. You know what I mean? So I think I'm really happy we are where we are doing what we're doing, because if you look at the data in those Mid-Atlantic, it's more of a steady tick up. We're
Yeah.
not getting that massive migration into our markets, but we are retaining to some degree. And we have seen development, especially in Philadelphia, on the multifamily side. But from a single family perspective, it's the built environment. An institution's not going to come to those markets, buy some massive tract of land, and put up and develop a built to rent community. It's
Yeah.
not going to happen.
It's a
It's just
limited land available, right, in the
exactly.
Northeast. That's the other factor.
Exactly. Yeah. So that means something, and it just provides diversification. Like I said, I don't think there's anything wrong with investing
Yeah.
in the South or the Midwest. There's definitely advantages. People, I think, are rethinking the South now with insurance and just now it's hurricane season and things like that.
Yeah.
But so people are really taking a hard look at the Midwest. I think there's something to be said for that, but I think from a healthy portfolio perspective, having geographical diversification, asset class diversification, all of that I think is very important.
Yeah. And as long as you have the teams and the
Sure.
process in place who can support, single or multi, doesn't matter, right? You have a right construction crew, you got a right
Yeah.
management team in place.
Sure.
As long
Yeah.
as you
We
make the money,
certainly
it's good.
exactly. We don't shy away from
Yeah.
multifamily. I mean, we
Yeah.
own, small multifamily. We've looked at, multifamily 100 plus units, 350 unit stuff. It's not that we shy away from it. I just think over the last couple years, it's been harder to make those deals pencil
Work
out. There's
out.
been
Yeah.
uncertainties in the market and things like that. So we've leaned more towards the single family space, but I think it's important as an active or a passive investor to be somewhat asset class agnostic, and don't be afraid to look at other opportunities and see what's out there. But having, a core competency and a core focus there's something to be said for that too.
Yeah, absolutely. So now, just changing the gears towards funding these projects, right?
Mm,
Funding your why. I know you have some funds you manage within your company to
yeah.
fund these projects for the acquisition. How does that work? Like, what are the different funds you have, and where does those funds focus? Like, what are the different properties or sectors they focus on?
Well, yeah. So right now we have two different funds that we're raising capital for. One we call the income fund, the other we call the growth fund. The income fund, I kind of like to relate it to our in-house private credit fund. So it feels very much like private credit. It feels like it's a fixed rate term with a fixed interest rate. And but we're not lending to anybody else. I mean, I think that's the big difference between our income fund versus maybe some others where
So you
they're
are
acting.
your own hard money lender,
Exactly,
kind of. Yeah.
exactly,
Okay.
exactly. Yeah, what I
Uh,
mean. So a lot of times you'll see hard money funds, private lending funds, where they take capital in and then they lend it to a fix and flipper, lend it to a buy and
mhm.
hold
Yeah.
investor. For us, we are the operator, we're the owner operator, we're the developer. So, when capital comes into us, we're the ones that are buying the properties, renovating the properties, and then leasing them and continuing to manage them.
Mhm.
Everything's done in-house. So that's our income fund. Then the growth fund is more of a traditional, we pay a preferred return and then we split profit, above that. So it provides tax advantages, the income fund. It does, because it feels like debt, it doesn't, there's no tax advantages on top of that. So at the end of the day, both invest in the same type of product,
Mhm.
both own their own separate, portfolios and properties titled separately in each fund. But the type of product they buy are the same. You know what I mean? So it's
Yeah.
workforce affordable housing. It's in that 130 buy
Mhm.
box, 200 ARV, that kind of thing. So it's just really different strategies, for the different investors, because there's investors that want more, I'll say,
Stable
predictable
income.
cash
Yeah.
flow. Exactly. I mean, steady income that's consistent. Certain piece of our portfolio is going to be subsidized at any given time through Section 8 vouchers. So that provides some predictability of cash flow. It gives them the opportunity for shorter term. It's just that's good. And there's no UBIT in an IRA. So that's perfect for some
Mhm.
investors. The other type of investors, maybe they're working, they have a great, full-time job that's making them, a good buck. They're looking for more of something that's tax advantage. I mean, something that's more upside and a longer hold, that kind of thing. That's where our growth fund comes into place. So, kind of trying to, fit both sides of the spectrum for investors, depending on what their wants are and their needs and their goals, that kind of thing.
All right. Okay. So it all depends, right? As you mentioned, type of return the investor wants. They can either invest in the steady, the income or the growth fund, and the return of investment is different on in both the
Exactly. Yeah, it
so different.
varies
Yeah.
between and like
Yeah.
the income fund has different options depending on how much
Yeah.
you're investing and
Yeah.
the type of term
Mhm.
you want to lock in for. I was just thinking of something else. But yeah, it depends kind of on what your goals are
What
as
your
an
goals are.
investor, that kind of thing.
Yeah.
And I'm always happy to talk to people. I'd like to understand, what their needs are at the end of the day, and what they're looking for, what they currently invest in now and how what we do may or may not, help them to achieve their goals.
Mhm. And as an investor relationship manager, I would say, right? Uh, what are your main process or strategies to attract the investors, retain the investors?
It's I actually my phone's right here. It's picking this bad boy up. You know what I mean? Like I had I have my license in Pennsylvania, my real estate license, and I
Mhm.
have a broker who's been a good friend of mine for a very long time. And one thing he told me was, if you want to be successful in real estate, this is just kind of general, advice. Pick this up. And when people call you, if you can't pick it up, get back to them.
Yeah.
And that has been kind of my anchor, for 10 years in this business. You know what I mean? I really pride myself on getting back to people if I'm available, picking the phone up, having conversations, having real conversations, getting real. One thing I think people always applaud us for in our presentations, and we do quarterly financials, and then we do a management review call after that, because a
Mhm.
lot of people don't know what the heck they're looking at. You know what I mean? So we want to make sure that we're going line by line. We do a written explanation of everything, so we're explaining all of that, and then going line by line in the balance sheet and the P&L and the portfolios, so people understand what it is that we're doing, and there's no surprises or anything like that. But just so many times, I'm always looking for investment opportunities and things like that. So these presentations are so scripted, you know what I mean? And
Yeah.
it's just, a lot of times they don't do like an open Zoom where you can have conversations. They do like the webinar, style or presentation, whatever they call it. And you don't even know how many people are on there. It could just be you, or it could be 100 other people. You have no idea. We like to do things a little bit more intimately. We try to operate as a boutique in that sense. You know what I mean? Where everybody has my cell phone. They can call me. They can text me. If, like I said, if I'm available, I'm going to pick up. I'm going to talk to you as long as I can. I really want to make sure people people understand what they're investing in. We're very passionate about what we do. We think it's a great investment, but it also it's an impact. And I mean, it's an impact investment. Our kind of slogan right now has been rebuilding essential homes for essential workers in essential communities. So we're making a difference in the lives of our tenants. We're making a difference in the community we invest in. So we have a strong message and a mission that we want to share with people. And it's not perfect for everybody. And I mean,
Yeah.
not everybody gives a crap about having an impactful investment or something
Yeah.
like that, but a lot of people do. You know what I
Yeah.
mean?
Yeah.
So we love that portion of what we do. But I think that's the most important thing. I've had investors recently in the last couple of months, I had a number of my investors who have known for a long time diverting some additional funds to us, and they told me, I'm in this other investment. It's working, and I'm going to assume they didn't lie to me. I mean that it's working, it's making great returns, but the operator, the guy who's running, he never gets back to me. I call, and I leave a message weeks and weeks if I ever hear from him. I send an email, it's weeks and weeks. And I get it. We're all busy. We're all,
Yeah.
doing all kinds of different stuff and traveling and doing podcasts and writing, social media and all this stuff. I get it. But me personally, I don't think there's any excuse for that. You know what I mean?
Yeah.
I think, if somebody is going to trust you with investing their hard-earned capital, something that they had to trade a lot of time, a lot of energy, a lot of, just blood, sweat, and tears for, the least you can do is pick up the phone and you can have an
Absolutely.
honest, real, open conversation with them. So I really pride myself on that. You know what I mean? That's something that I value. It's important to me. So when I hear people say that, that means a lot. And you can see it's just like they could be making a great return, maybe even better than what we're providing.
Yeah.
But you get to an age maybe or point in your life where you just say, you know what? I would rather be investing with something where, I have the guy's phone number. If I got a question, if I want something, I mean, I can call him and we can have a real conversation. You know what I mean? So that's my investor relations philosophy.
Yeah, that's what I believe into too. You should have a personal connection with all the investors.
Yeah,
Should be ready, available anytime they want.
exactly.
Yeah.
100%.
Yeah. All right. And any specific softwares, applications that you use for managing fund, managing investors?
Yeah, from a Excel can do a lot. You know what I
Yeah.
mean? I use a CRM, but CRMs can be chunky, and you got to keep up with them and all. I'm a note guy, I always have paper and pen around, but it's important to take the time, either yourself or maybe if you have a VA or something like that, to get the notes into the computer. You know what I mean?
Yeah.
Like I
Yeah.
tend to do that a lot where it's like I have like, just copybook upon copybook, and like, and a lot of times there was just something the other day, like where somebody said something. I thought, I know I have notes on that from like 5 years ago, but I can't find the freaking copybook. Like, like I'm looking for this copybook and I know because it was like a small copybook, like I can picture it and I'll find it eventually. You know what I mean? So I take a lot of notes and, I'm a handwritten guy. I do like that. I think it's it's like my therapy in some sense. You know what I mean? I like putting pencil to or pen to paper, that kind of thing. But then we use a CRM too, and I think that's important. But there's a lot you can do with Excel if you know how to use it, and just kind of you have to do something because the longer you're in this business and the more marketing and the more outreach you do, the more people you're going to talk to.
Yeah.
And the magic's really in the follow-up, right? If you're raising
Absolutely.
capital from somebody, not that we don't have those investors that the chances are they kind of were, for lack of a better term, stalking you, in the background maybe for years, who will come in on the first conversation or something like that. But most of the times it's not going to work that way. You know what I mean? Most of the time it's going to be, it's a courtship, and it takes time. So you want to follow up and, and I'm not saying I'm not the best at that. You know what I mean? Like it's something I always think I can improve. I was just at a conference where this amazing guy spoke and talked about the power of networking and, the power of, taking notes. Now I'm the kind of person where luckily to some degree, if I talked to you 10 years ago, I might not remember your name, but I'll remember that I talked to you. And I might even
Yeah.
remember what you do and all that kind of stuff. So I'm a little blessed in that sense. But not everybody is that way. So I think it's important that you take notes and you write them down, whether it's through Excel or your CRM, and and just keep up with it, and just stay in front of people, and share your story, and just pleasantly persistent. You know what I mean? I think is important. I've had a
That's
lot of
true. That's
people
true.
where it's like I hit them up, could be a year or more, and they appreciate it. You know what I mean? I think that's
Yeah.
one of those things where you feel like you might be bothering somebody. I know some people that do. I could call out names right now from some from some service companies. I swear to God, they call me or email me or hit me up on social media every single day. That's a little overboard, but being persistent, I think is powerful. And people tend to be thankful for it. You know what I mean? It has been my experience, especially if they're interested. It's just maybe it's just not the right time. You know what I mean? That happens, right? You know what I mean? Like
Yeah.
I get that with people all the time where like I'll something about fundraising or marketing or something. I'll have sales type calls with people, and it's like they hit you up and like they're like, well, are you gonna buy it? And it's like, well, it's a timing thing. You know what I mean? You're not the only person I'm talking to. You know what I mean? So it's all about timing
Yeah.
and just being pleasant and persistent. And when the person's ready, they'll make they'll make it happen
Yep.
when they want to.
No, absolutely. And that's perfect. It's true. So, yep. So, Peter, loving this conversation, but want to be meaningful of your time also,
Sure.
mindful of your time. Wanted to move to the final round of questions, but before we go there,
Okay.
is there anything else you'd like to tell to our listeners?
I think it's just do your homework, and don't listen to a lot of the noise. A lot of times we were talking about this before we started the podcast. It's
Yeah.
important to I like to take in news and listen to different stuff and different opinions and things like that. But at the same time, always ask yourself, what's the agenda, right? I mean, what's that person selling? And then, do your own, due diligence and your own homework as much as you can, your own research, and learn to ask really good questions. I think
Hmm.
that's what's really important. And I love doing these podcasts and stuff because like the questions people ask is going to take down different paths, or somebody might say something you never think of or something like that. So take advantage of getting on the phone with people, having great conversations, learn to ask good questions, and then take advantage of these communities that are out there, and things like that, where you can learn from other people and hear what they ask and that kind of thing. But it's important that you don't confuse commercial real estate and residential, and even from a residential, from like a multifamily to single family side, there's differences. There's differences in the financing that's available. There's differences in supply and demand. You can't, like, a lot of times with news sources, you're looking at real estate from a macro perspective, and they're
Yeah.
aggregating information from all 50 states. But real estate's local, and you
Yeah.
really need to get down to that micro. So you might need to research a little differently than you would. You can't just throw it in Google. You know what I mean? Like, you got to get a little bit more dialed into what it is you're doing, that kind of thing. So I would just say look at the macro, but also look at the micro, and and just learn to ask really good questions, and you're gonna have an easier time whether you're a passive or an active investor.
Love it, man. That was a good advice. So, Peter, we'll move to the final round of questions. Are you ready?
Okay, let's do it.
All right. So, what is the one book that you'll recommend which had the most impact on your life or on your business?
Yeah, so the one book I would recommend would be Win Friends and Influence People. From a sales
Yeah.
perspective, from a investor relations perspective, I mean, that was a book that really changed my life, and something that I come back to on a regular basis, and kind of it's one of those foundational, kind of pillar type books that you want to revisit, and every time you read it or you skim through it, you'll probably pick up something you forgot, you know what I mean, or you missed the first time around. Because I think in this business, whether you're active or you're passive, relationships are everything.
Everything.
It's especially for the quality of the investment or the quality of work from a construction standpoint or a property management standpoint or tenants. It's like relationships, the importance of relationships, having good relationships, being able to talk to people, be real with people, is just so crucial on every level of this business, whether you're active or you're passive. So I think that book's a good place to get started and something, to take seriously, especially in a world of social media and the phones and things like that. For the younger, for my generation, for younger generations, that's going to be a skill set that really sets you apart. And if you can talk to people, you can ask good questions, and you can listen. I think you're going to find success in this business from an active or a passive side.
Yeah. Yeah, I love that book too. And that's a
Good.
really good read. Yeah. So, and next question, what are your main source of information to learn and grow?
So I would say my network. I certainly I look at all kinds of news sources, and I try to stop. I try to limit my time on LinkedIn because you could really get lost. LinkedIn's really popped off over the last couple years. I mean, you can really get lost on there. So it's having those people in your life that are active, that are doing stuff, that are constantly. They're on a quest to learn. There's so many different ways you can take real estate from an active and a passive perspective, from commercial to residential, from new development to lending to, core, type investing, stabilized investing. So there's so many things you can always be learning in this business. I like ULI and what's the other one I'm in? ULI and well, that's God, I forget the name, but NIOP. I mean, like they're good like industry events, where you can industry resources and groups where you can learn a lot. They have really good news sources and things like that. And then I just think keeping in touch with the right people who are active. You're going to get more of a what's actually going on. What are you actually experiencing, that kind of thing. Because I think that's more important than anything, to talk to somebody who's actually doing it and the boots on the ground. They tend to give you a lot of different perspective than what an article might give you or something like that.
I can't agree more on that, for sure. Yeah. All right. What is the best business or investment advice you like to give to our listeners?
Um, so God, there's so many things, and it's going to depend on what type of person you are, you know what I mean? So maybe I would say that, is before you do anything, take that life assessment, you know what I mean? Take the time to really understand yourself and your goals and what you want to achieve, your purpose, all that kind of stuff, because that's going to help you to know if you're heading in the right direction or if you're heading in the wrong direction, if you're surrounding yourself with the right people or the wrong people, all that kind of stuff. When you go to real estate events, especially the longer you're in this business, you'll see some of the same people there all the time. There's
Yeah.
some people that are constantly doing stuff. Every time you talk to them, they got a new deal. They're doing this. They're growing. They're doing amazing things. And then there's other people who they still haven't taken the leap. You know what I mean? And it's like, well, maybe this isn't what you want to do. I mean, maybe it's not for you. You know what I
Yeah.
mean? Like my brother, he's a business guy. He's an MBA, corporate America, corporate finance guy. Like he doesn't want to do this business. And I mean, he would probably want to invest more in like in private equity or venture funds or something like that with me. It's so landlording and yeah, tenement. It's not for everybody. You know what I mean? So I think it's very important to start with that life assessment, and look at yourself foundationally. What are your strengths? What are your weaknesses? What do you like to do? What excites you? What can you do that you don't have to necessarily force yourself to do it? And then find ways that you can, leverage other people's, strengths and things like that and forge great partnerships. So I would say, start with the life assessment and that's something you do it right. You come back to it on a regular basis and because you're going to add to your foundation over time as you
Yeah.
learn new things and meet new people and stuff like that. So I would say start with a life assessment. Don't skip that part. You know what I mean?
Yeah.
Because
No, no, that's
that's going to
absolutely
eliminate
true.
a
Yeah.
lot of stress,
Yeah.
a lot of confusion, a lot of because there's some people too when you go to these events, they're doing something different every single time you talk to
Yeah.
them. You know what I mean? Like and I think if they understood, if they did that life assessment part and they understood what their purpose was and what they want to do and all that kind of stuff, that would probably help to eliminate some confusion.
All right. Well, Peter, final question. How can Decoding Cashflow listeners get in touch with you?
Sure. So start with the website, gsprei.com. You can schedule time with me on there. You schedule time in person over Zoom at our office. We're in Chesterbrook, PA. Always don't be afraid to reach out. Let's have a conversation. There's a lot of educational information on there too. We've done presentations and articles and things like that. So it's a good place to learn. So I would say, start with gsprei.com and then let's have a conversation. Just schedule time through there. I'd love to learn more about your listeners, what they're investing in, what they want to do, what their goals are, and see how I can help any way, shape, or form.
All right. Sounds good, man.
Great.
Peter, it was a pleasure talking to you. It was nice having you on the show.
Same here, Ted. Very happy to be here. Great conversation with you.
All right. Take care. Bye.
Thank you.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.